There we go. And I have brought on source advisors. This strategy for not just cost segregation, but some of the other strategies within that have been very critical for me securing listings as a commercial agent. So I thought we would expand on that and have source advisors go through what they specialize in, which is cost segregation and some other aspects of that. Becky is with Source Advisors. Becky, why don't you take it away and tell us what we're going to talk about today?
Okay, sure. I'm Becky Sissom Hewitt. I'm a Senior Director of Business Development for Source Advisors, all things sales. I've been with the company since 2005 and have seen all kinds of different properties come through for cost segregation and our energy credits that we have. I'd like to introduce Brian Coddington. He's our Director of Tax Accounting Methods and Credits. He's got more than 10 years of experience, has represented taxpayers before the IRS for numerous reasons, including cost segregation, research credit claims, and accounting method changes. He is an enrolled agent, a mediator for the state of Texas, and has pursued additional studies at Texas Wesleyan University School of Law. So he's very knowledgeable in this realm. And given that, I'm going to turn this over to you, Brian.
Thank you, Becky. Good morning, everyone. So today we're going to be talking about tax saving strategies for real estate owners. And this is always a hot topic. What can people do to save money on their taxes? So what we're really going to do is we're going to go through the different stages of property, acquiring property, owning it. What are the exit strategies? And then we're going to look at a few other issues that are related to real estate. So building has a life cycle. Someone either builds it or they buy an already existing structure. That's the easy part. They own it, and during its life, they have to make repairs. Sometimes those repairs are substantial enough that they have to remodel, and so they get rid of some of the assets and parts of the assets that are actually inside the building or outside, doesn't really matter. And then we circle all the way back to where they either sell or exchange the property, and the cycle begins all over again. So as we go through the life cycle of the building, this can be a short process. This can be a many decades long lifespan, but it always goes through the same cycle. Someone buys it, builds it, maintains it, cashes out. So when it comes to acquiring property, there isn't a whole lot to discuss. Someone buys it, someone builds it. Now, you actually work in the real estate industry, you're going to be much more expert about acquisition and even construction than I am. But when someone does buy a building or when they build something, one of the best strategies that they can undertake is cost segregation. And I always like to think of cost segregation as someone hands us a bucket of costs, or they hand us a single line item on the depreciation schedule or a purchase agreement or statement. And we use our expertise to divide up that single number to organize that bucket of costs. And we put them into generally the most advantageous categories for federal income tax purposes. Now I say generally, because whether it is most advantageous, well, advantageous in what way? Is it that we get someone the biggest deduction? No, sometimes that's not the goal. It's meeting their tax goals. Now the general goal, yeah, we're going to try to get someone the largest deduction possible. But that may work great on the federal side, but maybe they're in a high rate tax state like a California or a New York, where what works for federal doesn't really work for state purposes because they use slightly similar but slightly different tax rules. So instead of cutting it up one way, we cut it up a different way. And a real easy way to think about cost segregation is most people buy a building and they see, well, it's a building, that's it. Cost segregation looks at it and says, well, no, you've bought a structure, a shell. You have bought land improvements surrounding that building, decorative shrubbery, sidewalks, a parking lot, a portico. You have assets inside the building. You have kitchen cabinets in a break room. You have a break room sink. You have decorative lighting. And through using an incredibly diverse number of IRS rulings and court cases, about 2,000 over the years, we look at the facts and circumstances and divide up all of the assets that are purchased during a building into different categories. Hence, we take the costs and we segregate them. And the real play here, there are two. We're accelerating depreciation from over the course of 27 and a half to 40 years into 5 years, 15 years, maybe even a single year. And that creates a cash benefit for the taxpayer in the near term. And it also, because of the time value of money, creates huge present value savings today. Now, of course, people don't always hang on to buildings for 40 years. So we can also analyze, well, what happens if they sell it 2 years down the road? What happens if they sell it 10 years or 20 years down the road? What are the tax implications of that? And we'll touch on that a little more later on when we get to the exit strategies. But if you want to think about cost segregation, think about just slicing and dicing costs, the cost of a building from one line item into dozens or even hundreds to take advantage of the tax rules. So in general, the additional depreciation created by these shorter lives generates anywhere from $30,000 to $200,000 for every $1 million our clients spend on buildings or tenant improvements. And that's being conservative. If we're talking about tenant improvements, just building out empty office suites or retail suites, for example, 100% of that might be able to be deducted in a single year, thanks to the wonders of bonus depreciation, which we've had off and on since post 9/11, and right now since 2017, we've had 100% bonus depreciation on most shorter lived assets, such as tangible personal property and tenant improvements. So when we're looking at different properties, there are going to be different benefits based on the type of property. Some buildings just make better targets for cost segregation. It can be based on the complexity of the building's technology, what types of finishes and fit out is used, the amount of the site improvements. If site improvements right now can be deducted entirely in the first year. So if you're looking at a building in Midtown Manhattan where there are no site improvements compared to a sprawling retail development in a suburban area, which has acres of parking lot, well, that'll affect the benefit. And finally, the taxpayers' business activity heavily influences what's going on. A manufacturer or data center is going to generally get a much better result than a distribution center. And some factors also impacted, such as, is it ground up new construction? Is it an existing building that was acquired? If it's existing, were there renovations or tenant improvements to get it where you needed it to be? So we have a lot of assumptions here. We're not going to walk you through them. They're in the slide, but I'll just walk you through a few of these different categories. I said a distribution warehouse isn't all that great. You look at the top of the chart and, well, you follow the numbers down and it looks like it gets about, a little over 25% reclass percentage in a good situation. Might be around 5%. So distribution warehouses, not always that great. Now, if they're also used for manufacturing, well, that's a different situation. Hotels are pretty good, but not the best. And, at the opposite end of the scale, you have, well, all tenant improvements, because right now, most of them are going to be 100% deductible. But once you drop down below tenant improvements, R&D facilities, manufacturing, data centers, auto dealers, these are great targets. But so are multifamily garden style apartments, full service hotels, strip malls, grocery stores. The key point here is that there aren't really any bad targets. It's just, what's the actual return from cost seg? And as part of our normal process in selling cost segregation services, we offer a no cost estimate of the benefit before we're engaged. So people have a good idea of upfront what they're actually getting into. And we have a very good track record of meeting those estimates. Now, that's great, but what is the actual benefit? So let's take a look at that warehouse. It's a worst case scenario. So for each $1 million of capitalized costs, warehouse in the worst case scenario may get you only about 20 grand out of $1 million reclassified and increasing their cash flow now. And when we say cash flow, we mean not just the deductions, but multiplied by their tax rate, which we usually assume is the top tax rate, somewhere 35 to 40%, depending on state and local taxes and a bunch of other issues about whether the tax rate is, it doesn't qualify for qualified business income deductions. Is it in a C Corp for some reason? A lot of reasons why the tax rate may vary. But whatever we're told it is, that's what we're going to use for the estimate. And this benefit, this first year increased cash flow, that's always a part of our estimate process. Because obviously people love to hear that, you spend $1 million on improvements and you're going to get $350,000 cash back in your pocket. You can look at it as the government underwriting the acquisition, construction, and improvement of real property. Congress loves the real estate industry most of the time. So everything is heavily incentivized to get real estate to change hands. And right now, you can see that range of benefits. Warehouses are still bad. Data centers are still the best. But there are a lot of really good targets all the way between. So here we get a little technical. Don't worry about all the abbreviations and strange symbols on this chart, because what this chart tells us really is this is about bonus depreciation. Bonus depreciation is just Congress telling us, hey, you can write off some part of an asset instead of having to depreciate it over 5, 10, 15, 20 years, whatever. You get to write off all or a portion of it right now, depending on what we say. So over most of the last 20 years, bonus depreciation has been around 50%. And I know we only show back to 2011, but there's a limit to how small we can make this chart. So when we're looking at it, 50%, you have a 5-year asset. So that first year, you get 50%. You pay $1 million for an asset, you write off 500,000 immediately. But wait, you get the regular depreciation on it too, on that remaining part. So it's really 60% in the first year. It's a great deal. Not as great a deal as we have right now, because you'll see a red box in the middle, and that red box is the sweet spot. If you acquired or constructed a building after September 27th, 2017, and placed in service then all the way up through the end of 2022, the short life assets generally will qualify for 100% bonus depreciation. It's very hard to get a better deal than that, unless of course Congress approves some sort of investment tax credit where you get a dollar for dollar reduction for investing in certain assets. We haven't had one of those since 1986. Well, general purpose one at least. There's a limited purpose one for energy investments, but we're not really going to cover that. But the bad thing about that red box is that all good things come to an end. Right now, unless Congress intervenes, bonus depreciation is going to drop by 20% next year. Means if people are hesitating on the deal, you want them to have it wrapped up and get that building in service by the end of this year rather than next year if it's at all possible. Put some pressure on them to get the best tax results. And every year afterwards, after 2023, it drops another 20%. Until 2027, we don't have any bonus depreciation. Now, you'll see in the second column a similar countdown for what we call pre-TCJA bonus. And the reason we see that is Congress actually did intervene, and they basically said all those deals from before September 28th to 17, well, those deals use the old rules. Deals after that get these new favorable 100% bonus depreciation rules. I know this is boring, but it's good to see that Congress actually stepped in and said, no, we want to reward people for investing and constructing real estate. That's exactly what they did. They did not let 50% bonus depreciation go away. Instead, they said, no, we're going to step on the gas, push it to 100, and we're still waiting to see whether they'll do that this year. There's a lot of speculation that maybe after the midterm elections in the lame duck session of Congress at the end of the year, that they might, in fact, re-up bonus depreciation at 100% next year. But that hasn't happened yet. So don't count on it. It'd be nice though. Then there's something else. You've probably heard of it, Section 179. Most people have heard of it. That's why so many people over the last 15, 20 years have bought large SUVs, large pickup trucks, cargo vans for their business, that is. Because Section 179, even before bonus depreciation existed, it allowed people to write off assets, allowed small taxpayers to do that, but not everyone. And this chart really just captures what you can do when you're buying or constructing assets right now. So don't worry too much about all the technical terms. You don't really need to worry about them, especially the historical stuff. But right now, and since 2018, someone makes an improvement to an interior part of a building, they can either expense it under bonus depreciation or write it off under 179. Now there's some exceptions. Certain work for elevators and escalators, parts of the structural framework, you know, the slab, the column grid that keeps building from falling down, that stuff doesn't qualify. But most assets inside the building will qualify for bonus depreciation in 179. Now for commercial buildings, but not residential ones, if they make improvements, like they add a new roof or new rooftop air conditioning units, outside security cameras or fire protection systems on the outside, alarm systems, those things can be expensed under 179, even if you can't take bonus depreciation on them, even if you can't otherwise cost segregate them into a shorter asset life, you can still expense those if they're on a commercial building. Now, there's a little bias in 179 expensing. Historically, it didn't apply to residential rentals. Now, that's actually changed for most parts of it. Doesn't apply to roofs, HVACs, any of that stuff for residential property, but it does apply to any short life property that cost segregation study identifies in a residential property. Things like phone systems, wiring for computer and data systems, decorative finishes, carpet. Of course, bonus depreciation applies to most of those things too, so it's not a big win for residential stuff, but it's nice. And we do cost segregation studies on many types of residential property, not just high rises, not just garden style apartment complexes, but also we look at single family residential homes. We look at Airbnbs. And so all of these present wonderful opportunities for cost segregation. Now, sadly, with Section 179, as you probably know, if you've ever tried to buy an SUV for your business, there are limits to it. And in general, 179, it's tied to inflation now, so the limits always go up, but right now, you can't go above 1.05 million in expensing Section 179 assets. And if you have more than 2.62 million in qualifying assets for Section 179, then the expensing limit gets reduced dollar for dollar until you're at 3.67 million, at which point you have no Section 179 expensing. So it gets phased out. It's great for smaller taxpayers, not so good for big ones. All right. Well, I mean, now we're over the technical part. We're back to owning the property. What happens when someone owns a property? Well, we have these things called the tangible property regulations. You might want to think of them as repair studies, disposition studies. What we do, we can go in to a client and we look at whether they have assets on their books, costs on their books that maybe they capitalized them on their books, but maybe they really qualify as a repair and they can be expensed for tax purposes. Maybe there's a safe harbor that says it's not really a repair, but you can expense it anyway. There may be a de minimis safe harbor, a threshold under which if you didn't spend that much, you know, say under $2,500 per asset, that's determined by the invoice, that you can expense it if you have the right policies in place. Or maybe it's not even it's not an asset, it's just a material and supply and can be expensed immediately. Now, there are also these things called dispositions and general asset account elections, which are a little complicated, those elections, but dispositions is just, you know, when we go into cost segregate a building to make the depreciation beneficial, we can also do what we tend to call an enhanced or an asset management study, where we identify the long life components too. So when someone goes into, say, a hotel property and they redo the property every 5 to 10 years as part of a property improvement plan, well, we identify they knock down a wall. We can tell them, well, this is how much that wall is worth now, and you can take a write-off for that. Because that wall is going to be depreciating over 39 years. It's not one of the short life assets that was depreciated over 5 years or 15 years. It was just a 39-year asset, but you get to year 5, year 10, they knock it down. Well, the remaining part, we can tell you how to write that off. So this is a very complicated chart that walks you through some of the analysis. But let me sum it up. Building is made of not just a structure, but a bunch of different systems like HVAC, plumbing, electrical, things like that. Now, if we adapt the building or building system to a new or different use, we have to capitalize that cost. If we have a betterment, that is, did we replace a building system with a better, stronger, or working type of replacement? Did you have a roof with shingles and now it's a good metal roof? That's a betterment, has to be capitalized. Or thinking about that roof, did we say take off, not just reshingle it, but we took off the plywood decking, maybe even replaced a couple of the joists? Well, that's a capitalizable event. And we use our knowledge of the tangible property regulations to perform a repair study that tells you, can you write this off as a repair? Or if you can't write it off as a repair, can we take that partial disposition when we get rid of the old roof? Then we'll tell you how much that is. And you give that to your CPA. Your clients give that to their CPAs, and they're able to get good tax benefits. So in the beginning, we cost segregate something. Then while someone owns it, we can look at repairs and dispositions to continue to get good tax benefits throughout the life cycle. And so here we're just looking at what are the major components of each of these building systems. What is something that if we replace it, we have to, capitalize it? Unless there's another rule that intervenes, like a safe harbor says we can get around it. And that's, really where we come in. If this was a mechanical rule where you say, oh, we replaced a generator, therefore we have to capitalize it, it's on the list, you wouldn't need us. We're here because we have knowledge of all the safe harbors and other factual scenarios where we can get the best results under the income tax laws. And a lot of the time, we're still going to look at this in addition to cost segregation when someone buys and then renovates a building, because a lot of states don't believe in bonus depreciation. Oh, I'm sure they'd love to do it, but if you've been around, states, their budgets aren't the same as federal government can run huge deficits. Doesn't go over too well in the state capital. So a lot of states say we're not going to allow bonus depreciation. It's too expensive. So we have to look at repairs and dispositions as a way to approximate the result you'd get with bonus depreciation and the cost segregation study. That's it. So now we're going to come to exit strategies. Now, one of my mentors, what he drilled into me, outside of how to actually write an outline instead of a memo, because he's too busy to read a memo, is always ask what the exit strategy is. And that's a big thing that differentiates source advisors from most other cost segregation firms. Most cost segregation firms they'll do a cost segregation study. Might even be good, but most of them stop at that. The good ones will also do the repair studies, the disposition studies, but then they usually stop. And when it comes to the exit strategies, they say, well, we're just going to assume you'll own the building 40 years. Well, you own a building 40 years, it's a lot different than owning a building 5 years because you're an investor. You're trying to make money in real estate, not buy it and use it in your own company. Even if it is being used in your own company, exit strategies are important because when do you plan to outgrow the building? Is it a large property where there's going to be an expansion of the existing building, 5 or 10 years out? Or is a move going to be necessary in 5 or 10 years if the growth plan is met? Well, what we can do that differentiates us is we actually analyze what happens when you've had a cost segregation study and the building is sold. Congress favors the real estate industry, but not without limit. Many decades ago, I think it was around 1962, so 60 years ago, Congress said, if you take advantage of accelerated depreciation and you sell those assets at a gain, you have to recapture all those depreciation deductions you took on your old returns. Now, there are ways around that, and we'll get to some of those in a few minutes, but the basic idea is that when the property is sold, you're going to have recapture at ordinary income tax rates on everything we cost segregated in the original study. So, 40 years on, it doesn't matter much. In 2 years or 5 years, it can matter a great deal. And if need be, we will actually show what those results would be. And what we can do, this rarely happens, but what we can do is on the back end, if we've done the original cost segregation, it's not very difficult, especially when we've done the repair studies over the years while someone's owned a building, to come back in and assist in a sales price allocation. Now, what these pie charts attempt to show is on the right-hand side, you have a building with no sales price allocation. 30% of the property was, non-depreciable land, but 21% of the property was short life assets that we identified in a cost segregation study. And they were entirely expensed in year one thanks to bonus depreciation. Well, when you're looking at selling in, say, year 5, all the depreciation on that 5-year tangible personal property that we carved out gets recaptured. Most of the depreciation on those land improvements gets recaptured. And now for the building itself, there is no recapture. There's something called unrecaptured 1250 gain, which is slightly less favorable than gain taxed at a capital gains rate, but most people aren't concerned with that because they're going to face it anyway on the building. What we can do is we do a sales price allocation cost segregation study update. And after 5 or 10 years, generally speaking, land depreciates, buildings depreciate. It's been turned on its head in recent years because can't build buildings fast enough. And definitely not in desirable locations. But what can still happen is there are a number of factors we can look at to reduce the allocation of the purchase price to the short life assets. So instead of just looking at how it was allocated originally in the original cost segregation study, we can say, well, the tangible personal property is now worth less. It's only worth, it's only 5% of the property because it's aged, it's somewhat obsolescent, there's deferred maintenance, all these other wonderful factors that help reduce the allocation to the short life assets and push it more towards the building or the non-depreciable land, so that there's more capital gains, less ordinary income recapture. Now that's on a straight across sale. Most people don't look to sell property that often. Well, right now some are. Some people like to sell property right now because we have what they believe are historically low tax rates. That's a valid opinion. I myself think tax rates are going to increase in the future, depending on the fortunes of politics and whether we happen to be in a recession at the time. No controlling for those things, but in general, I think we're going to see an increase in tax rates over the next few years. But even so, a very popular real estate strategy now is the like-kind exchange, also known as the 1031 exchange, the Starker exchange, or it has a bunch of names, deferred exchanges. But the real point is that someone has a building, and we're just going to assume they didn't cost segregate it. Instead of selling it, they're going to hire a qualified intermediary, basically an escrow situation where they sell the building, the funds go into the escrow at the qualified intermediary, and they don't touch the cash. The cash is used to reinvest in another piece of real property. And that's a key distinction. It has to be real property. Congress changed up the laws, and no matter how much they favor the real estate industry, sometimes they have to make things a little more fair for everyone else, you might say, but can't do exchanges on personal property. And you may have picked up on the fact that when I was talking about cost segregation, tangible personal property was one of those big categories that we identify and qualifies for bonus depreciation. Well, I'm using different terms, and it's more than semantic. Tangible personal property for depreciation purposes is not necessarily personal property for 1031 like-kind exchange purposes. They are somewhat similar, but the rules are very different. So what very frequently happens is the 1031 exchange defers gain. You see this large 50% gray part of the circle? Normally when you buy a new building, everything except the land is depreciable. Here's a building where it's 50-50 split, land and building. Maybe it's somewhere in California where a 50-50 split between land and building is reasonable. But because it came through a like-kind exchange, there's another part of the purchase price. Deferred gain on the sale of the old property means it's not something that we can touch. We can't cost segregate that deferred gain. It just sits there on the books waiting for it to be the property, the replacement property, or 5 generations down, the replacement property after 5 exchanges. When that is finally sold in an outright sale, the deferred gain is recognized. Now, of course, the real strategy is people just exchange stuff until they die. And when they die, they get a basis step up, the taxes are never paid. And if I could build a time machine, I'd go back and tell my grandfather, look, here's a Starker exchange, just happened out of California. I think that was in late 70s, maybe late 60s, before my time at least. Here's what you got to do. Maybe I wouldn't be working today, but maybe I would. I love this stuff. But anyway, what happens is most people do a 1031 and they only cost segregate the additional cash or debt they put into the new deal to trade up in value for the new property. What we can do is we will help work with someone's CPA to make sure that they get the maximum cost segregation benefits, that they do a 1031 reset election so that we can reset all of the depreciable basis. And not all of it gets bonus depreciation, but it all gets shorter tax lives, well, except the building part. But that's never going to change. There's always going to be part of a building. So that is a good example of big differentiator for Source, is that we will work with CPAs to help work through like-kind exchanges. And I mentioned that the laws for identifying personal and real property are different for depreciation and exchanges. We can help with that too. It's not unusual for us to advise looking at the facts and circumstances or even each state's law to identify certain assets that are real property for 1031 purposes, but personal property for depreciation purposes, to deliver on that best of both worlds. Quick depreciation, but gain deferral on the exchange. Now, we don't just do cost segregation and repair studies. We actually look at number of other opportunities. And before we dive into what those opportunities are, I just want to briefly touch on how does a tax credit work? It's not the same thing as a deduction. I know the terms get used and abused and people call credits deductions and vice versa, but they're actually different. So think about someone that has $10 in income. They face a $40 tax rate, sorry, 40% tax rate. In that situation, $10 times 40%, they pay $4 in taxes. We go in, we get them a $1 tax deduction. Well, that only saves them 40 cents, $10 income minus $1 deduction, all of that times 40% means they pay $316 taxes, just in case you're curious about the math. Now, tax credits are better. Tax credits provide a dollar for dollar reduction in taxes, for the most part. By dollar for dollar, we mean if there's a 30% tax credit and you spend $1 million on whatever the tax credit is generated by, well, then you get a $300,000 tax credit. You don't get $1 million tax credit. But what that tax credit does is that same $1 in tax credits, it results in $3 in taxes. Big savings compared to a deduction. And the reason that's important is there's something that's called 45L. It's named after a part of the Internal Revenue Code. And it is an energy efficiency subsidy for residential housing. If someone develops housing, could be garden style apartments, could be tract housing, could be a single family residential, but usually it's not efficient to get this credit for the single family home, unless there are a lot of them built at the same time. What it does is, if using energy modeling and in the field tests, if you meet certain energy saving standards for new homes, then you get a $2,000 per unit tax credit. And the tax credit arises if you meet those tests and you get it, claim the credit when each unit is sold or leased for use as a residence. Now, credit, maybe it generates too much in savings. If it's not allowed in the current year, it's carried back 1 year and then forward 20 years. So it's not something people have to worry about if it can't all be used in 1 year. And right now for 2022, it's not even available. It expired at the end of 2021, but fortunately, we can go back and amend open year returns to claim the credit where property qualifies. And that generally means the last 3 years, so 2021, 2020, 2019. And there may, in extraordinary cases, be situations where we could even go back before that, but not going to get into that today. It's complicated. So the basic idea is that energy efficient single or multifamily properties can qualify for this credit. Now, whether someone qualifies for a credit or not, that's highly influenced by where they are and what type of property. So when we're looking at a home, say in, tract housing in Houston, Texas, it's probably not going to be very energy efficient. We look at a similar property in, let's say, North Carolina, well, different rules there. They actually have zoning laws. So it's going to be a lot more energy efficient. Low-income housing developments that qualify for the low-income housing tax credit are often very energy efficient because it helps them qualify for those credits or financing. So 45L, we expect it to come back at the end of 2022 for 2022 as part of a tax extenders package. If you're not too familiar with tax, Congress, writes into law a lot of neat benefits, but they let them expire. So there's a whole lot of lobbying going on, and eventually enough of them get together in a single bill, usually called an extenders bill, and most of the time it's passed around Christmas, maybe Thanksgiving, after that year's elections and what we call the lame duck session of Congress, because a lot of people are going home for good and they don't care what they pass anymore. Now, eligibility. So this isn't for speculative developments where someone develops a property and then sells it off to someone else who will lease it out or sell it to the residential users. No, this is for people who construct and either sell, say, houses directly to homeowners or who develop apartments and then lease them out. The owner operators, if you want to think of it that way. So there are a couple of rule of thumb qualifiers. You have to have a SEER rating of 13 or higher and at least 80% AFUE furnace. Now me, I'm not an engineer. I have no idea what that means. We don't really care about furnaces down here in Texas where I live. Definitely care about that SEER rating though. Fortunately, we employ professional engineers and HERS raters who work throughout the United States to qualify properties. There are also minimum insulation R values. And see a few examples, things like low E windows and insulated exterior doors, insulated foundations and slabs. Those things are going to help qualify a property. This was a huge opportunity through 2021. A lot of companies saved tons of money, tons of taxes because of building energy efficient properties. And finally, we're going to talk about the energy tax credit. I mentioned the investment tax credit. This is one portion of it that's still around. It's a tax credit. You have to reduce the basis of the property for depreciation by half of the tax credit. So if you get a 30% tax credit, you get depreciation on 85% of the cost of that property, which means it is more or less, it's a think it's called a negative rate of return. You're getting great benefit. Most things are going to be 5-year recovery periods. That means they get bonus depreciation. So for example, for $1 million solar panel installation, get a $300,000 energy credit the first year, get $850,000 in depreciation deductions. That is $640,000 in tax reduction. And you can see the math there. You get a $300,000 credit plus, deduction times tax rate. Double dipping is allowed. You get this for wind, solar, various types of alternative energy investments. And so it helps make the benefits of investing in solar and wind and geothermal energy. Now, I got to mention, this is not the residential credit you may have heard about, you may have even taken on your own tax returns. This is for businesses. And you also have to be careful. There are a lot of scams running around energy credits. People who purport to transfer ownership, of say solar panels, for instance, so that individuals who aren't in a business try to qualify for the credit. Well, I'll mention that it's a real thing out there, and the government has, for the last 40 some years, have tried to police that area. Not always with success, but if someone has a property and they're adding solar panels or in the right part of the country, geothermal, this may be something to look at. All right, so that takes us to the end of our presentation. As the presenter, I can't actually see the questions that may have come through in the chat. So other presenters who can see that, please let me know if there are any questions.
Dusty, I think you had some questions early on. I don't believe I can see the questions either. But Dusty, I know you had some. If you go ahead.
Well, that was Brian. Thank you so much, and Becky as well. That was fantastic.
Welcome.
So many questions for me, and I've got some from the investors that I know who wanted me to ask them as well. Couple things. You mentioned the I think it was the Tax and Jobs Act of 2017 that took us from 2017 to the end of this year for that bonus depreciation this round. If people buy stuff all the time. If they bought it in 2016, right? Say they bought a brand new a building that they bought in 2016. What can they do to do can we do a look back and do some bonus depreciation for that asset?
Well, for a purchase building, no, there's no bonus depreciation, but if it's way back in 2016, what we can do is we file a form called Form 3115. It's filed with the IRS and with the tax return. And what it allows is to catch up in all the depreciation that should have been allowed if they'd done cost segregation from day one. And, looking back at 2016, all the 5-year assets will be depreciated away at this point. The 15-year assets will be more than 1/3 depreciated away. So there's going to be a lot of catch up, a big cash benefit in 2021 if they were to do a look back study right now, or 2022 if they've already filed and don't want to amend 2021 for the 3115. Great question.
Yeah. This is great stuff. And so I've got people who have bought stuff perhaps after 2017, maybe in 2020 or 2019, who would have the same question. I have not, maybe they've done a straight line right off and done any cost segregation study at all. What could they do?
Same thing applies, but this time they get 1, bonus depreciation, and 2, they don't have to go back and amend returns. A lot of people, especially investment partnerships that deal with real estate, hate amending returns. In fact, amended returns generally aren't allowed for cost segregation studies if the property was placed in service more than a year ago. You have to file that Form 3115. And even for properties placed in service in the immediately prior year, say 2020, if you haven't filed your 2021 return yet, you can file a 3115 now, no amending the partnership return, no sending out new K1s, because we know investors always hate to get updated K1s, especially if they aren't expecting them.
Yeah. Yeah. Okay. Another question I might have, I'm just putting my investor hat on here. Say I bought a building and then did a cost segregation studies. We pulled everything out and we did what you do. But next year I replaced the roof on my multifamily building, for example, and I've got like 5.
Well,
what happens there? Do we claim the balance of the value of the old roof and then restart a new schedule for the new roof? What happens there?
it depends. It depends on what you want to do. And there are a couple different options. One, the new roof, if your investments in CapEx spend are small enough that year, the new roof would qualify. And so you said it's multifamily, so it won't qualify for 179 expense. Yeah, almost went down the wrong path. Well, so it doesn't qualify for 179 expensing, but what it does qualify for is we can first look, okay, what actually happened? Was the roof basically resurfaced, or did we go down, replace the decking, plywood, metal, whatever it is? How far down did we go in replacing the roof? And if the answer comes out right, then, well, you can deduct the entire cost of replacement roof as a repair. Now, if that doesn't work, those facts just aren't there, then what we can do is because we've presumably done an asset management study and we've already identified the cost of the roof, we can go back in and say, well, this is how much the roof was replaced. This is how much the depreciation was. This is your write-off. That remaining basis of the roof that you replaced, this is how much you get to deduct this year. Now, even if you didn't have that, there are ways we can get at that in the current year if you didn't have a cost segregation study. But that takes some more explaining. We can trend it backwards using replacement cost and different methods.
Okay. I'm totally down to nerd out with you right now.
Wonderful.
So me as a building owner, I'm getting ready to sell the building. I do have an old roof, for example, on my multifamily, just to kind of keep it consistent. Would it be beneficial to me to replace what essentially assume it's a capital expense, not like a repair, but it's like a big capital expense. Would it be beneficial to do that and claim some sort of write-off just before I sell it?
Well, the neat thing is that when the tangible property regulations were adopted, 15 years ago, our answer would have been to say, well, it's a capital expense, it increases the basis and it reduces the gain on the sale. Therefore, that's the best opportunity. But now we can look at it and say, well, is it really a repair? And is that tax deduction as a repair worth more right now than decreasing the gain on the sale? Because it has to be weighed. Decreased gain on the sale because you've capitalized additional basis, or repairs. Depends on the rates, depends on where they are, cap gain versus ordinary income. And if the rates are close enough, we can figure it out when it comes down to that situation.
And me, sorry to expand on this, but me as the owner, right, it's my best interest to report the appropriate amount of income and then the capital expenses as a separate line item when I'm selling it, right? Because my net income is important. If we classify it one way on your study and then maybe a CapEx on another study, on my income and expenses, is that doable or is that not allowed?
It is doable. There is for repairs, there's no book tax conformity required. In fact, the IRS expects them to be different because they know that GAAP accounting rules are different and favor capitalization, whereas tax accounting rules favor expensing.
Excellent. Very cool. I was wondering with the energy efficiency stuff, what qualifies for that, right? So say I have an office building or even like a multifamily where I decide to put, maybe I decide to do carports and then those all have like solar panels on them, right? Is it just the solar panel expense or is it the carport as well? You know, what amount of that can I include?
It depends on the facts and circumstances. So the solar panels are definitely in. The carports by themselves, probably not. To the extent that there are dual purpose structural supports for the panels that may also work with the carports, sometimes those can be allocated depending on how they're constructed. But yes, it's definitely possible that it could be more than just the solar panels themselves.
Okay. And then if I had to like reinforce the roof or something, if it was on the roofs, would that
Right.
qualify?
Yes, at least part of that would generally qualify.
Right. You said something that I have yet to learn about, 1031 reset election. Basically, you can buy a new property during your exchange and then do something.
Right, your CPA would file an election statement with your return. And what it allows you, instead of continuing to recover that building over, the remaining 39 or 27 and a half years of its depreciable life, you get to reset it based on the new property and cost segregate out the the short life assets, 5 and 15-year land improvements.
That's awesome. Wow.
Definitely.
So everyone needs to call you if they're buying anything as an investment, it sounds like.
Right. Just pick up the phone, call Becky, and we'll get you taken care of.
Right. Well, that was really, I think, let me look here. I think that was all the questions our team had here. Yeah, I think that was pretty much it from us. Becky, was there anything else in the chat there that had some questions?
I have not seen any new questions come in other than what you asked. So again, just feel free to reach out to me if you do come up with some questions, and I'll definitely get them over to Brian so we can get them answered and help you.
Great.
But
Great.
thank you for giving us this opportunity.
Oh, that's fantastic. You guys this is amazing. And again, this is how I've gotten a lot of and you've expanded my knowledge significantly. But just what I had before was really how I'm getting a lot of my listings, because there's a huge benefit to doing this. And a lot of owners just don't think about it. How can we get a hold of you? I don't know if there's a slide here that you guys have where they've got your information or not, or we can give it to them after the fact.
And here it is.
There it is. Okay. So if you guys want to learn a bit more about this, contact Becky or Brian, and they'll get you going on whatever path would be most appropriate for you or your investors.
And please note that my email address is incorrect there. It's actually becky.sism-hewitt@sourceadvisors.com.
We'll make sure anyone who's on here, if you're watching this, we'll make sure an email goes out to you with different contact information for both them and myself if you want to talk to me about, again, I do brokering real estate transactions. Guys, thank you so much for this. This has been amazing.
Wonderful.
Welcome. Thank you for having us.
Brian.
You're welcome. Have a great day, everyone.
Bye-bye.
Thanks.